January is usually one of the best months for the stock market, but not this year. Check out some of these headlines. Nasdaq is on its track for its worst January ever as volatility gets to panic. Or this is an awesomely bad headline. It's official. I'm glad it's official now. Stock market having worst start to year ever. And you can see they got a nice little chart here on this article showing the S&P 500 down 8.6, Nasdaq down 13.5. So what's an investor to do? Well, we're going to talk about that, and I'm going to give you some ideas from some stocks that might be of interest to you, whether you're a value investor looking for an undervalued stock, a dividend investor looking for a good, safe dividend stock, or maybe a growth investor looking for a stock that might be a little undervalued. All that is coming up on Investing Education with me, Mr. B. Welcome to the channel where we help you to learn fast so you can become a confident and successful investor. If that sounds interesting to you, check out the courses I have in the description below, or do consider subscribing. All right, so this January 22 is just terrible. Just a terrible start to the year. And there's a lot of stuff going on, right? I mean, we've got Russia's rattling its saber here with Ukraine. Certainly we've got supply chain issues. Inflation is really rising. We're going to look at rising in interest rates to combat inflation. Supply chain we mentioned. And oh wait, there's this pandemic still going on too. So there's a lot of bad news, which is kind of good news because it's all kind of baked into the market already. So as investors, what should we do? And I think the thing to take away from that is to be true to who you are. You be you. You be the investor that you are. If you are a very active trader, a day trader, for example, and you really learn, use chart patterns and technical analysis. I have a whole course, 12.5 hours, just on reading charts and technical analysis and active trading. Well, this is not a bad time because there's a lot of volatility. Prices going up and down, wild swings on a day, which gives you opportunity to trade very actively. So there's opportunities there. But let's say you're a buy and hold investor. What should you be doing? Well, you got to be you, right? You've got to be true to who you are. So if you're a buy and hold investor, you got to do those things. You've got to hold, right? So if you're looking to hold stocks through good times and bad, but over time it's going to rise in value, well, that's where the hold part of being a buy and hold investor comes into. So this is where you're holding. But also the buy and hold part is the buy part. When stocks are down like this, there's opportunities for buying stocks and getting in and buying the dip. You've heard the expression buying the dip, right? They're dipping down. Buying when the prices have come down and holding for long periods of time as the prices go up again over the long term. That's the whole idea of buy and hold. So again, be who you are as an investor and stick to that. I remember during the Great Recession, holding on to stocks and buying stocks. I remember the early days of the COVID-19 pandemic. Remember when the stock market was just crashing? I remember holding in core parts of my portfolio. I did some active trading too because I have that little part of me as well. But I also bought at that time and bought into stocks that have then since rebounded and are still doing well. So consider you be you, and who you are is so important. So let's look at 3 stocks just to give you an idea, and we'll look closely at them depending what type of investor you might be, whether you're following either active trading or buy and hold, but also kind of looking at, from traditional investing standpoints. Like there are some investors that are value investors, they're looking for undervalued stocks. So I got a stock here that's at a very low price to book value. That's something as far as a undervalued, who's looking for a bargain would look for. People who want safe and predictable dividend stocks. This could be a second category. I've got a stock that really fits that criteria. And thirdly, maybe you're looking for growth stocks. And certainly growth stocks, you see with the Nasdaq, those stocks like technology has really taken a hit. So there might be some opportunities there to look for stocks that are really reasonable price compared to the sales or revenue they generated. So hang with me on this part. We're going to look at one stock in each of those categories that might be of interest that you need to do your due diligence on, but might be able to spark some ideas. So let's take a look at that. So for what I think is a very undervalued stock, and I talked about this in a previous video actually, is Citigroup. And I was looking at stocks that had a low price to book, right? Under a 1.0 and P to B or price to book. And this one fits the bill for that. You can see they pay a nice dividend too, like a 3.18% dividend, very reasonable price to earnings ratio of 6.38. So some good solid numbers there. If we go under statistics here, I'm on Yahoo Finance. We're looking for a price to book under 1.0 to be really super undervalued. And this is, in fact, it's, if you look over the past quarters, it's been kind of consistent there. So if you're looking for something that's a good major company, Citigroup, banking group company, Banks will tend to do better during rising interest rates because they can raise their interest rates too that they pay to their borrowers and increase that spread in terms of the money they make. So banks can handle like inflation and rising interest rates better than a lot of other sectors. You can see they're up about 8% over the last year compared to the broader market, up 16. But a nice dividend, 3.18%, very low payout ratio in terms of paying out that dividend at 20% out of their net income. So they're not going to cut their dividend anytime soon there. So, a nice, good price to book type of price terms of stock. So that would be our, price to book undervalued stock, right? So let's look at now our solid dividend stock. This one was a 3.18% dividend. That's pretty solid. Let's also consider Gilead Sciences. They've had some ups and downs from, some of their treatments, some of their COVID type stuff, but they've got a lot of different, pharmaceutical types of product lines, and they put a lot of money into research and development. And check out that dividend, 4% dividend, 4.13% dividend. So that's meeting our criteria of a really good high-paying dividend stock. Let's see their payout ratio. Can they keep paying that high dividend of 4%? And if we take a look at that, I'm going to come back to something that popped out too. But if we look at their dividend payout ratio here, 47.87%, below 50%, that's very, very solid. Anything in payout ratio under 70% is generally, rule of thumb, considered pretty safe, pretty good. And if you look at their current ratio, can they meet their current debts? Yeah, they're over 1.0 on that is a good number, so we're at 1.37 there. And they've got $6 billion in cash. They got a lot of total debt, $27 billion, but $6 billion in cash, and look at these cash flow, operating leverage cash flow. They're generating lots of cash from their cash flow statement. So, they're in pretty good stead there as far as keeping to pay that dividend. But one thing that popped out to me too was their PEG ratio, their price to earnings growth ratio. If you can get a PEG ratio under 1.0, that's a pretty attractive from a valuation standpoint. We're looking at earnings and growth, combined in that PEG ratio. That's a good number to look at that. By the way, if you're curious about some of this stuff, again, here's a little small plug. Go check out the courses below. You'll learn all these kind of things. But what we're saying here is a good price earnings growth ratio, a really nice dividend of 4.13%, and a good safe dividend with a less than 50% payout ratio. So that's our dividend player as far as a good higher dividend safe stock. And we look at one more. Let's look at a tech stock, right? And just a kind of a run-of-the-mill tech stock, Western Digital, making hard drives, different things like that, WDC. Maybe you've invested in them, before. For tech stock, 11.4 on that price-to-earnings ratio, pretty good. Earnings per share, 4.78. When I'm recording this, they've got an upcoming earnings announcement, so you can see after hours here, it's up 2.5%. So we'll see, depending how, check out their latest earnings, see how they did. But there's some good anticipation around that. But if we look at their statistics, I'm looking at price to sales, right? So now I'm going to look at what's the value of price versus their sales or revenue. And the same thing where we're looking to be right around 1 or below 1.0. Particularly, that's hard to find in tech stocks. And you can see Western Digital here. I'm at Western Digital. Their price to sales is at 1.0, right? So you're getting a really good price for the sales you get. If you look at other tech companies, these numbers can be 2, 3, 4, 5 or higher. I think the average is like 6.5% right now in tech. Even with tech stocks being down on the price side, you're still paying high for that. Are they the greatest innovative tech stock in the world? Nah, maybe not, but they're a pretty solid tech stock. And their PEG ratio also is another one that's really super low for the price you're getting for their earnings growth. And actually at a very reasonable price to book too, at 1.59, very, very reasonable. And as you can see, they're up a little bit over the last year, 3.5% versus 16% for the broader S&P 500. No dividends, so we don't have to worry about that, but good, strong cash flows. And look at that current ratio here, 2.09. I mean, again, they're in pretty solid footing. Even with all this stuff happening in the market. So as you can see, if you go out looking for certain stocks, you start being true to who you are. If you're a value investor, look for those low price to book stocks under 1.0. If you're a dividend investor, look for good dividend yields, but they have really lower and good payout ratios too, so you don't have to worry about that dividend getting cut. And if you're looking for tech stocks or growth stocks, you can find them. Look for those lower price to sales ratio ones. And with all of them, this is just the ideas. This is like watch list stuff. And again, it's not advice or recommendations, just kind of showing you what might be out there. Now you got to do your due diligence and really dig into that. There might be folks that say Citigroup or Gilead or Western Digital is the worst stock in the world, and once they do their due diligence, and that's perfectly fine. I'm just saying that even though the market seems to be in really tough shape, that there are opportunities out there. And to be true to who you are as an investor, whether you're a very active trader taking advantage of these opportunities, or if you're a buy and hold investor, staying in the market and staying in there and looking for opportunities to buy as well. All these things are things that can help you be successful and be a successful investor. So check out these companies, check out my other videos, would love to have you do that. Look in the description below for the courses. I got some free courses, and certainly hit that subscribe button to get alerted to more these types of videos. So with that, I wish you all the very best of luck, and good luck on your search to find great companies to invest in, even when the market is maybe not doing so well.